Hey everyone, thanks for joining us. Today we're talking about model portfolios, one of the fastest growing parts of the investment industry. There's already trillions of dollars in these portfolios, and according to some estimates, that could double or triple in the coming years. So you're going to want to learn about what these are and how you can use them for yourself or for your clients. Fortunately, I have the three perfect guests with me today to help us break down everything you need to know about this space. With me today is Tom Canatero, Director of Head of Models Distribution for U.S. Wealth Advisory at BlackRock. I also have Paul Ricardella, Executive Director and Head of Wealth Index Investments Coverage at MSCI. And last but not least, we have Dr. Yulia Plaha-Ferenc, Vice President of Equity Solutions Research at MSCI. Tom, Paul, Yulia, it's great to have all three of you here with me. To get us started, I want to set the scene a little bit and help the audience understand why they should care about model portfolios. Tom, why don't I start by asking you the most basic question, which is, what is a model portfolio?
Yeah, I think happy to hit that one. Model portfolios are really the way to think about it is it's a collection of investments that are created by financial advisors, asset managers, or broker dealers, and really they're built to meet clients' goals. They're usually comprised of different investment products like ETFs, mutual funds, separately managed accounts, and they're really great for clients that want an effective hands-off approach, don't have time to do their own research, that sort of things. And I think there's a lot of benefits around diversification, and they rebalance. So that's kind of a high level description of what a model portfolio is.
That's really great color there. Tom, I got another question for you, but Paul or Yulia, feel free to jump in as well. So we have a lot of advisors watching right now, and I'm sure they're wondering, what are the benefits of a models-based advisory practice?
Yeah, so financial advisors have a really tough job, as everyone knows, and especially now, clients are demanding more services, everything from retirement income planning, educational funding, insurance, tax planning, elder care planning. So you name it, the demands on advisors are more than ever, and especially in this environment where you have a lot of volatility in the markets. And when you consider employing a models-based advisory practice, there are a lot of benefits, but I would say like the three that really stick out to me. First off, you have the ability to scale and simplify your practice, and I'll go into a little more detail. The second one to me is you're able to manage fees, and especially using low-cost ETFs, you can really keep those fees down. And then the last benefit I would say that really sticks out to me is the ability to implement a defined investment process, especially in this heightened regulatory scrutiny that may be impacting your practice. So just going back to the first one around scale and simplicity, the average advisor that implements this type of practice saves literally hundreds of hours. And that we've done a couple of studies, and I've seen a couple by some other organizations, and there's on average 200 hours a year saved by using models in your practice. And think about it, like if you're using an individual strategy for every client, and you have hundreds of clients, like how much time does that take to prepare? So time savings is huge. And you get more time to focus on your clients to do all those things I mentioned around planning. The second thing is just around fees. We mentioned ETFs are a low-cost option that really help keep the fees down for your clients, and it's never been more competitive around fees. So I think that that really is a great benefit. And then the last thing I mentioned was just around the defined process. In this, if you look at SEC fines around the industry, they continue to rise. The number of advisors impacted continue to rise. Having a defined process, and using whether it's your own broker dealer research or an asset manager is really going to help give your clients a great experience and protect you from those. So those are some of the high level benefits. I could keep going, but I think in the interest of time, I'll keep it at those three.
Yeah, and that's an incredibly complete answer by Tom. I would maybe add a few more things, Sumit, or maybe put it in a slightly um, different way. One benefit for sure is that model portfolios almost force advisors and their clients to stay disciplined and committed to an investment process, right? It's easier to pull the ripcord in times of market volatility when you are not in a model portfolio versus in a model portfolio. Model portfolios also give you the flexibility where if you want, you can change the risk tolerance from the same provider of the model portfolio that you're in. And I'm sure your listeners are well acquainted with all of the data. When the market has a correction, the snapback generally occurs quickly, and not being invested in the market for any period of time can absolutely be detrimental to your long-term return. So I'd say forced efficiency is one sort of additional benefit. Tom alluded to the fact that hundreds of hours can be saved by, outsourcing the investment function. And I would just add to that by making the point that more is expected from advisors, and we're seeing it, in the types of like advanced degrees and CFP designations as a higher percentage of the advisory force. All of that means that there are things that they have to stop doing to meet the needs of taxes, estate planning, insurance. And so I think, that is a very important part of things. And then lastly, managing the entire portfolio through models gives them a little bit, better ability to manage the timing of cash flows and tactical trades as well, as opposed to doing it yourself. And so I think those are some additional benefits advisors should consider.
That makes a lot of sense, Paul. Tom, I want to go back to you. We've talked about some of the benefits of models. Now, can you talk about some of the ways that you can implement models?
Yeah, I'll stick to my theme of kind of keeping it at three, keeping things in threes. And I think there's three ways that I really see advisors implementing. Number one is just buying the model, kind of off the shelf, essentially. So there are, whether it's a firm like BlackRock or another asset manager, we have models that we've built that an advisor can, basically click a button, and depending on the risk tolerance and the desires of the clients, can just purchase the model, and everything is taken care of for them. The support, the trading, everything is done for those advisors. The second way I see is we call it almost like following a model. So many firms or research groups will have model portfolios that they'll post changes, and the advisor can essentially follow that model, and when they make a change, they can just implement the change themselves for their clients. And if they want to, tweak it or make some adjustments, they're able to do that. But generally, they're following some type of investment, IP, where they can follow an organization that's giving them that guidance. And then the third method is just building the model themselves. So, obviously very popular as well, where they work with different ETF providers and other asset managers to construct the portfolio that they think makes the most sense for their clients. And that could be more of a mixture of different products in there, but essentially building it themselves. So again, you can buy it kind of off the shelf, you can follow it, or you can just build it yourself.
Great stuff. Yulia, I'd love to get you into this discussion. Can you talk a little bit about what some of the challenges are when it comes to model portfolio design?
Right. Thank you, Sumit. So there are many different types of challenges that actually portfolio designers, I would say, are facing. For example, if we think about wealth managers who are building model portfolios from decades already, right? So they are usually creating, first of all, their house view, right? And the house view takes into account changing market conditions, and then wealth manager is developing based on that also asset allocation strategies. They also include risk management and the related portfolio construction challenges, basically, right? So because wealth managers would usually sort clients in different risk groups, right, which then imply different risk management approaches. from another side, there are those different or diverse client needs where like life cycle related needs, risk tolerance, or general financial, or even tax smart withdrawal plan. So that's all that wealth managers or model portfolio designers have to be dealing with. And then the whole industry actually faces today, clients expressing their desires for portfolios to deliver particular outcomes beyond the traditional risk return characteristics. For example, clients might be expressing nowadays wishes for holding assets with particular characteristics such as fintech or maybe genomic innovation exposure, right? So this is at the moment placed into the bucket of portfolio personalization. And at the end of the day, model portfolio designer has to take into account these two big worlds. So one is the classical house view, and another one is the emerging client desired outcomes. So they have to take the best of the two worlds and marry them, because they have to balance of wishes of market conditions, and still have those model portfolios have to consider cost efficiency and then changing client demand effect. At the end of the day, they also have to be able to effectively communicate the outcomes of the portfolio in a efficient way to the client. So these are the challenges. These are all kind of features of are expected features of model portfolios, and this requires flexibility, responsiveness, and even having some behavioral insights for wealth managers to craft those portfolios that can actually truly meet clients' financial objectives.
Do you have any insights or rough estimate for how many different models that the average advisor uses with their end clients?
Yeah, so I think the simple answer to the question is generally between 1 and 3. Most advisors tend to start with a traditional risk-based model that provides geographic diversification, asset class diversification, a full multi-asset portfolio. In that category, ETF only and hybrid models have grown share since I started focusing on this space a long time ago. But in addition to traditional models, generally advisors will complement that with something that's a bit more tactical in nature or outcome oriented, less bound to traditional indexes, benchmarks, and constraints.
Fantastic. Now I want to turn this discussion towards the current model landscape. Paul, what are the top areas of model portfolio product development right now?
Yeah, so I think that there's a few priorities that I tend to hear repeatedly from the model providers that I'm in touch with. And I would add that this is both at the wealth management home office level, as well as the external model provider level. And those commonalities, one, have to do with tax efficiency. Clearly taxes are an increasing focus for wealth managers in general. The technology to implement tax loss harvesting or tax optimization in an efficient way has only increased. And it seems like there's a lot more focus on that. The second major area of development is models that blend individual securities vis-a-vis direct indexing with commingled vehicles like ETFs. And so perhaps the core of a model is single securities that allow for efficient tax optimization, more personalization, and then the bulk of the holdings are commingled vehicles, all with a tax overlay. But we're hearing a lot more discussion on that particular topic. I think part of what's powering that is the increasing effectiveness of UMA style platforms, where these different types of investment vehicles can all be housed and traded in an efficient manner. Hybrid models tend to still be quite important and an area of growth. And certainly we're living in a year where the blurring between index tracking and active is getting greater. 5 years ago in the model portfolio world, a hybrid strategy meant mutual funds for the active exposure and ETFs for the index tracking exposure. Clearly, there's much more active within the ETF wrapper these days, and so that continues to be a big area of growth. And then, to Yulia's point, models that are more personalized, that allow technology to play a role in creating some sort of tilt is, a major trend that we are seeing. So amongst those four things, that's where the bulk of the conversations about the future have been.
Yeah, I think I'll just quickly add to that. I think Paul nailed it. I think that the four areas we see as well are a lot around tax sensitivity, more vehicle options, customization, and blending index and active. And I would say the two areas that there still needs to be a lot of work done, that there's some operational challenges around implementing more implementation of SMAs, and then also alternatives, especially like there's a few models out. We have a model, for example, that has liquid alts, but advisors, how do you have the liquid alternatives be part of a model? So I think there's going to be a lot of development there because there's demand, but we're I still think there's a ways to go.
How about in terms of flows? What types of models are attracting money right now?
Yeah, it's funny. As much as you've read a lot about the 60/40 portfolios being dead, if you look at the areas that attract the most money are target risk and target allocation models, and specifically, they're offered in different percentage allocations. The 60/40 takes in the most assets. So again, those target risk, target allocation style models are taking in the bulk of flows that we see, and I think you're starting to see some interest in some almost like completion models where it might be like a fixed income model, or again, going back to that alt theme, people are looking for alt solutions to mix in. So we're starting to see more of that, but right now it's still 60/40.
Yeah, and I think the only thing I would add to Tom's point, on the completion side of things, especially in wealth management home offices, we continue to see advisors who like the individual stock picks of their home office and want to use that as a core of the portfolio. But given some of the regulatory constraints that Tom alluded to earlier, are completing those, concentrated individual security portfolios with models that are mostly commingled vehicles. And so I think that's been, a big area of growth in a lot of very specific financial advisory networks. And then, the other thing I would mention is just the continued rise of the ETF only model. It's such an efficient vehicle, as I alluded to earlier. More active options are now out there, and so you can build an ETF only model that is a blend of active and index tracking at incredibly compelling fees, and it's got all of the liquidity and characteristics that financial advisors want for their clients.
All right, so we've talked a lot about the current model landscape. Now let's talk about the future. Paul, CIO home offices have traditionally had a large market share in the model space. How do you see that evolving in the coming years?
Yeah, so that's a really good question. All of the research and data that I've seen leads me to believe that CIO models or financial advisor created models, have somewhere in the vicinity of 80% market share. And so that means that the asset manager or third-party strategist models, generally have about 20%. And so I think that there are some competing forces, frankly, as the lines continue to blur between the manufacturing of investment product and the distribution of it. And there's no doubt in my mind that wealth management organizations continue to have ambitions to become financial product manufacturers. However, I think that there's a few distinct reasons as to why outside models created by asset managers and third-party strategists will gain market share in the next few years. The first reason is the rise of the independent advisor. Everyone's sort of well aware of the stats with more advisors working for independent firms or becoming RIAs. To me, that means they are less influenced by a home office or a CIO model portfolio, right? They are more open to doing research and finding the perfect third-party manager. The second dynamic here is that large asset management entities tend to have excellent distribution and really good networks within wealth management firms. And we've seen more asset management salespeople transition from more of a consultative portfolio building approach from specific product discussions 5 or 10 years ago. And I think that trend will continue, and they'll be able to use their distribution power to gain market share. And then the third important factor is that there's some benefit to these large wealth management networks of not having too much proprietary product on the shelf in models. And I would almost make the analogy to 10 or 15 years ago, where there were concerns about, the asset manager owned by a wealth manager having too many funds on the platform. I think there are similar modern day concerns in terms of models. And I think all of that creates an opening for asset managers and third-party strategists to gain market share. My expectation, though, is that CIO home offices will continue to have, a very high percentage of the total market.
Great color, Paul. So Yulia, I'm curious, how flexible or responsive are existing model portfolios to client personalization requests? And if they're not very flexible, is that going to change in the future?
Yeah, that's a great question again, right? So what do we see at the moment on the market, that the responsiveness and the flexibility of existing model portfolios nowadays pretty much depend on the wealth management firms, their approach, specific model portfolios that they offer, but also, which is very important, it depends on the technology and the resources available within that wealth management organization. So basically, one can find nowadays, model portfolios in the range from, limited flexibility portfolios to custom built portfolios. What it means, right, is then if we start from limited flexibility portfolios, it means that these kind of portfolios might only cater to specific risk profile or investment strategy, and basically would force the client to be fitted into an existing model, right? Where, wealth advisor will try to convince the client that this is the best model for, and very custom model. And then there are the moderately flexible portfolios, highly flexible portfolios. Maybe something which is interesting as well are automated or robo-advisory portfolios, right? But when we start off from one step before, from highly flexible portfolios, so their wealth managers can readily adjust asset allocations, they can select individual securities, even or implement alternative investment strategies to meet individual client needs. While automated and robo-advisory portfolios seem to be very similar, because they are very flexible and a lot of things can be changed, though they are generally designed for investors seeking low cost and passive investment solutions. And then we have those custom built portfolios. These are, more time consuming to create and actually manage, right? So because nowadays, most of those custom built portfolios are targeted for the ultra high net worth individuals, where, you have the whole team working for creating this one particular portfolio and then executing on that strategy. Today, wealth managers are actually all increasingly recognizing the need for greater flexibility, because we've seen recent PwC research here, they found that among high net worth individuals, 66% of US-based high net worth individuals are looking for more flexibility in their relationship and in their model portfolios. And half of all high net worth individuals that were questioned, right? So they are considering even changing their wealth advisor over the next 12 to 24 months. It means there is nowadays a lot more dynamic in this landscape. And as a response to that, right, so the wealth managers are looking for and exploring innovative tools and strategies that can offer, scalability while accommodating individual preferences. So today we see that advisors seek, to be better positioned and engage in discussions with their clients and guide their clients to, towards rational decisions where they can adopt, the best of the two approaches, so like one having a solid, well-defined model portfolios with well-defined risk-return profiles, and then accommodating those new client needs and preferences for personalization. All in all, to summarize, right, so it's a need and an ongoing search for the right technology.
Well, we have time for about one more question left. I'm actually going to make it a two-parter because why not? Paul, is optimization a tool you expect to play a greater role in the future of model portfolio delivery? And how about individual tax management? Do you expect that to be a part of model portfolios in the future?
So yes and yes, and let me elaborate on why. So I think, the vision for the model portfolio of the future is one where there's a marrying of commingled products, as we discussed earlier, with individual securities vis-a-vis direct indexing, right? And I expect all of that to have a tax overlay in the next few years. There will become a point, in my view, in the latter part of this decade where, tax optimization will just be table stakes for non-qualified accounts, right? It's not a free source of alpha, but it is a very repeatable way to enhance after-tax returns. And so I fully expect it'll become commonplace. Now, optimization allows for that tax loss harvesting in an automated way, but it also powers some of the things that Yulia was describing in her comments, whereby the data at the fund level is better than it's ever been. Even if, as I think about MSCI's innovations in the last few years, we have highly detailed ESG and climate data on funds. We have a factor classification standard for funds. We have a thematic exposure standard for funds. Any of those data points can be used as a parameter for optimization to tilt an individual client's portfolio in one direction or another, but stay within very tight tracking error bounds to the base level model. And so we very much see a world where 5 years from now, perhaps, wealth management firm ABC has a very distinct capital markets view. They're, perhaps overweight international equities, underweight short duration credit. Those views are proxied by a blended index that effectively serves as the gold standard house view and model portfolio. That blended index is then the anchor point in an optimization process whereby all of their clients get something that looks and feels and generally has the characteristics of the wealth manager's house view, but it reflects their individual tax situation and some of their preferences in tilting by geography, sector, factor, theme, ESG and climate, etc. And so optimization truly is the key to making that a highly efficient process and load balancing some of those different priorities in the model portfolio of the future.
Right. I just would like to emphasize maybe a little bit what Paul just described, right? So we see really optimization as the tool to structure and allow for that scalability of personalization of model portfolios. Because once you can identify those group of individuals that have similar desires or additional goals, such as Paul mentioned, which we nowadays allow very well to measure, such as thematic, sustainability related metrics, or maybe factor related metrics, and on top of that, the tax situation of each client, which is very different, right? With a wealth manager or a wealth advisor can separate those different wishes, then this is a very straightforward way of asking optimization procedure to balance or to optimize and find the best solution for each of these clients, which may have been put in one risk profile, but might have those additional wishes and goals that have to be managed on top of that traditional one model.
Fantastic. Well, this was a super informative discussion. I learned a lot, and I hope everyone in the audience learned a lot as well. Tom, Paul, Yulia, thank you so much for sharing your insights with us.
Thanks for
Thank
having
you.
us, Sumit.
Thanks for having us. Yep.
And a big thank you to everyone tuning in today. A replay of this webinar will be available on demand in the Media Center section of the ETF.com website. See you next time.